Hey everyone, it's Paul Sankey back again. We've got 30 years, no more, 35 years oil experience, oil and gas, energy, and I'm giving it to you from a Wall Street perspective. There's the Wall Street perspective. There's the oil barge, nice fat oil barge, probably full of gasoline, but could be heating oil at this time of year. And you can see there's some snow on the ground. Desultory amounts of snow, but it's been extremely cold here for the past week, and we're getting cold globally, and that's why we've turned quite bullish actually to start the year for a couple of reasons. Coming into the beginning of the year, we could see that tightened sanctions on the shadow fleet for Russia and the combination with cold weather in Europe particularly, but also in the US and somewhat in Northeast Asia, would be extremely a good way to start the year. And so we cheered up about oil, especially with the equities having been so beaten up. And I think that mood has sort of continued into the year because we ran our refining conference this week. We had 7 refining CEOs on, and while none of them are hysterically bullish about 2025, they are more constructive about the outlook. Right as the conference was in mid-blast last week, we got incremental sanctions on Russia's shadow fleet, which is really material. And that's caused the oil price to pop. So basically Russia's continued to export quite a lot of oil, particularly crude oil, particularly very discounted crude oil, to India and to China. And that's obviously increased the profitability of their refining. And whenever you get international improved refining economics, it tends to be relatively disadvantaged to the US refiners. But what's happening now is that with the ban on the Russian shadow fleet, we have a number of significant effects that will come through. First of all, you've already lost Iran. Secondly, you're losing quite a lot of Russian volume to India and China, which is causing issues. The latest sanctions go against the insurance companies that have been insuring the tankers, and nobody wants to run around $250–300 million worth of crude in a tanker uninsured, and so it's a major issue for the tanker owners as to whether or not they can continue supplying these very discounted Russian barrels. So that's incrementally, undoubtedly bullish. Now, probably won't cause oil to go extremely high over the course of the year because Saudi still has its spare capacity, but Saudi's committed to holding the line essentially through May. And so we should see a tightening of the market here from what are quite low inventory levels over the course of the run into driving season, and that's why we like the oils here, and particularly why we've cheered up a lot about the refiners, because there's a couple of other incremental news flow items that are positive refining. The first is that the major Lyondell refinery in Houston is going to finally shut down in Q1. And the problem in the refining margin environment has been excess supply from refiners running too hard. And as a result of this major refinery, 250,000 barrel a day plus refinery shutting down starting now, we're expecting the Gulf Coast to tighten. And in the back half of the year, the same effect will hit LA when Phillips shuts down its LA refinery, and that is another tightening effect. Globally, the market seems fairly well balanced, with incremental additions of capacity about the same as incremental demand. But we do have these retirements, and there should be some incremental retirements also in Europe to help things out. At the same time, we've got cold weather in Europe, so distillate margins there. There's basically a natural gas crisis, and that's causing distillate margins to spike. So again, that's bullish US refining. And so the outcome of this week's conference was basically to come in fairly bearish refining and bullish crude, and to come out bullish refining and bullish crude. And so whilst we're not really seeing a secular case here for, let's say, $100 a barrel oil, in fact the opposite, we continue to see major secular headwinds in oil, notably the shift in gasoline demand and the weakness in China, which we think is secular. But on the other side, you've got to say that as we start the year, the market looks quite nicely tight, and it's going to be up to the Saudis how they manage the price going into summer. But with additional refining downtime in the US, we should see much better margins coming through, when also boosted by cold weather. So that's that. The AI theme continues to boom. We get an announcement every week that's just massive. This past week, the biggest was undoubtedly Microsoft saying they're going to spend $80 billion this year in the AI theme. And of course, we had one of our favorites, Constellation, announcing a highly accretive deal for Calpine, which caused Constellation stock to rip 25% on Friday. And this is glorious for oil and gas analysts who are sidling into utilities coverage, because in the good old days you would get a refiner taking out a refiner, or a E&P taking out an E&P, and you'd get a 25% pop in the stock at times, certainly in the takeover candidate. But in this time, it's great to see that after a few years where we've had very disappointing premiums for big oil deals, we can get deals in utilities that cause major moves in the stocks, and that's exciting for the sector. So we remain very bullish on that gas-to-AI theme and utility theme in general. Vista is another one we like, if you recall, and we like some of the turbine makers like GE Vernova, and our stealth oil play on that theme is Baker Hughes. On the refining side, we dig leverage here, operational leverage. The companies have good balance sheets, so they're much safer bets than they used to be. They have much better quality shareholder bases. But the two operationally levered names that we would like would be Delek, which is restructuring and continuing to improve operations, and PBF, where the CEO has put out a major cost savings target, $200 million for the year, worth $6.50 a share, believe it or not, on a $20 a share company. Is pretty remarkable, and that's a major personal promise from the CEO, Matt Lucy. But the fact of the matter is that PBF is highly levered to the refining environment in general operationally. And if you think that what we're seeing here is severe sanctions pulling Russian oil out of the market, Trump pulling Iran out of the market, which is already happening, Saudi producing more oil as a result, and all of that coming with demand good with winter, and a couple of major refining shutdowns, it all adds up to a very bullish environment, ostensibly in 2025 for PBF on a stock that's really quite cheap. So we've got to watch margins closely as we watch this LyondellBasell refinery shut down, because margins have to go up in that shutdown. If they don't, it's super bearish. But right here, we like being long refining into what happens over the next 2 to 3 months. And that's kind of our call at the moment. Anyway, let's see poor miserable Achilles. He's out with me today. Come, Achilles, come. He's gonna get attacked by a bigger dog. Athena's gonna go nuts. Pretty miserable weather. All right, that'll do it. Welcome back. Good to be back in Brooklyn. Have a great week. Paul Sankey. You gotta have energy, Alex.